Good afternoon. Welcome to Market Wrap number 111, where we give you some views and reviews of research and ideas for the UK residential property market. Much of it has been taken as tongue-in-cheek. Okay, it's not that serious, but we're just trying to get some good ideas out there. It's generated to try and combat some of the end is nigh journalism that you do see out there. They're all designed just to get algorithms motoring and advertising selling. I try and make it relaxed, and I'm trying to pitch it at a common sense level. And no, as R.R. David Warren suggested, I'm not a psychic. I'm just doing some research and trying to interpret it. So this week, will a 3% interest rate rise? Will a 3% interest rate cause the UK housing market to crash? This is taken from the latest Knight Frank report. So let's have a look at it. We have 4 Bank of England Monetary Policy Committee meetings ahead in 2022, with the next announcement on it on August the 4th. The current tone suggests to Knight Frank that rates are likely to end 2022 around 2.25%, up from the current 1.25%. So obviously it's a 1% increase over the next 2 meetings. This will be conducive to a moderation in the housing market, but not a crash or a correction. The rate of 1.25% is the highest since global financial crisis, with the market implied expectations now of 3% by the end of 2022. Forecasters such as Oxford Economics and Capital Economics expect lower at 2% and 2.5% respectively, with Capital Economics forecasting 3% next year. The Bank of England's market implied path for rates puts it at 2% this year, rising to 2.75% in 2023. The prospect of a faster rate tightening, a 50 basis point rise in August, taking the rate point to 1.75%, is something looking increasingly likely, and I think it's true, it's going to happen. One big reason for this is the exchange rate. And I don't know, as expatriates, you know, if you're earning here, it's great. If you're earning in the UK, it's bad. Exchange rates. In 2022, so far, the pound has fallen 9% against the US dollar, meaning imports are becoming more expensive, which would add to the inflationary pressure that we're experiencing. Something the Bank of England obviously wants to limit as much as possible. Inflation, they want to be at 2%, is now at 11%. The Fed Reserve increased their rates by 1%, okay, at a very high increase. So we're talking possibly in the US more rate increases. So what does this mean for the housing markets? It's up for debate. Some, as Capital Economics, forecast price corrections, whereas Knight Frank believe that there will be a softening in price growth. Here, Knight Frank shows the housing market, how it could be impacted by rising interest rates. Okay, so there's a number of different scenarios they put forward. In the short term, there will be a limited impact due to those who have fixed in a rate in the past year or so. We've already been through this in previous market wraps. You know, over 80% now, I believe it is, are at that situation. In general in the market, over 90% of borrowers have been locking in rates, according to mortgage lenders and administrators. Cumulatively, this means that it is in fact now 82% of outstanding mortgages are now on a fixed rate, up from less than 30% in 2013. And the average interest rate for these has fallen to 2%. Okay, so offshore we don't have this, but the UK, that is a great situation to be in. So many borrowers will be unaffected in the short term by these interest rate increases. And I know I've mentioned it before, but it's very important to see that to assess whether they're on a cliff edge or not. Those existing borrowers can move their mortgages, and other new borrowers may have locked in rates already. Okay, so basically you can port your mortgage, and we're going to come on to that in a minute. There is still underlying demand in the housing market. Perhaps those who have been waiting to see what the work patterns are for like post-COVID. Also, first-time buyers or those looking for second homes without existing mortgages. They may have already locked their rates in, which can be valid for up to 9 months. So you get a decision in principle now, get it approved. It can be locked in for up to 9 months. Seems to be offshore, it's only 3 months, but in the UK it's longer. Existing homeowners, Those who have remortgaged or on existing rates, as already discussed, can port to a new mortgage, i.e. transfer their existing mortgage as it is to a new house, and so you don't get a new higher rate. Estimates are saying that previously around 20% of home movers ported their mortgages, and they're expecting, according to the Confederation of Mortgage Lenders, this to increase. Number 3, stretching affordability will weigh on housing demand in the medium term. Payments have increased by an average of £230 a month, or 32% since September 2021. When we factor in rate and house price changes using nationwide averages. For a 75% loan to value 2-year mortgage, average rates raised by 168 basis points from 1.2% in September to 2.88% as of June. The base rate has moved 115 basis points by comparison. That pushes mortgage repayments to 36% of average income from a low of 27% in early 2020. If rates do continue in expected path and reach 3%, it is reasonable to expect with Knight Frank current forecasts and wave forecasts from Oxford Economics that this proportion of mortgage repayments will push it up to 42%, and a level not seen since 2008. That's pretty high. So is it the end of the world is nigh? Okay, however, as rates are likely to peak there or even fall in the medium term, look at our next point, we will see a much lower than 49% seen prior to the financial crisis. Okay, so we're looking at 40% and below as opposed to 49% at the financial crisis. It's not the same. On the downside, affordability is stretched further by rising energy bills, food prices, other expendables. On the upside, though, wages are rising and may exceed expectations. I mean, some of the strikes that are going on at the moment, 8% is not acceptable. These are big rises. So point number 4, affordability will start to weigh on new mortgage demand. Mortgage approvals have started to soften, indicating that demand is cooling, but not drastically. New approvals in April and May were 66,000 and 66,200, respectively, from 69,500 in March. While slightly below the 12-month pre-pandemic average of 66,700, this does not show a dramatic slowdown, but is an indicator worth looking at. Number 5, the market expects that rates will reverse course in the medium term due to a slowdown in growth. The 5-year swap rate, which is a leading indicator for the path of mortgage rates, has risen steadily from a low in November 2020, that's correct, isn't it, 2020, of 1.18% to a recent high of 3.17%. However, given the increasingly negative, neutral, not positive musings and the impending recession headlines, they have since come back down to 2.7%. The pattern has been the same across most maturities. This ties in with higher rates in the short term, but indicating that a cap of 3% of the policy rate, which will then fall back in line with what the Bank of England is saying on their implied rate path, means it will be down at 2.25%, probably by the end of 2023. This chart illustrates that this will push mortgage payments as a proportion of average income back down to 35%, which is historically where it has been. Whilst above the level seen over the last decade, it is low historically. If energy bills decline, the picture looks at one of easing budgets. So in short, there will be a softening in the market, and as Knight Frank say, it's more of a process of normalisation of the UK housing market rather than a massive correction, owing to rising rates and perhaps the belief that the market may be peaking. Supply will continue building, which will begin to alleviate some of the price growth pressure. The outlook is consistent with Knight Frank forecasts that price growth will soften and not fall off a cliff or be subject to a sizable correction. as the market returns to a more normal pattern, which is distorted by COVID and a stamp duty holiday. Stamp duty holiday was madness, really. You know, the last 2 years have been exceptional. It was put into place by COVID. They believe the rates will continue rising in the near term, yet with economic clouds looming, particularly inflation, the Bank of England's primary concern will be to get that inflation down below 2% again. Once it starts returning down to that lower figure, which although it sounds like amazing, it will happen over the next year, they will then be cutting interest rates, and the swaps are saying it's going to happen in the middle of next year. So that means interest rates should be falling by the end of next year. That's it for this week. Take care, do share, like, circulate, those sort of things if you wish. If you don't like it, that's fine. Add more comments. That's lovely. Thanks very much. Cheerio.